Hello and welcome to the third and final installment of our option overlay video. My name is Benoit and I'm the lead portfolio manager and president here at Exponent Investment Management. Now, many of you have been investing in equities either directly or through mutual funds or exchange traded funds. However, I'd be willing to bet not many of you out there have either heard or know how to incorporate options into your portfolio investment strategy. Now, options are, I would say, misunderstood and you would even dare say often abused in terms of their intended uses. Now, the series of this 3 short videos was intended to teach you the basics of options, the 3 concepts. The definition of an option and then time and volatility are really the 3 concepts that we want to cover in these videos. And the idea was after these videos, you'd either be able to decide whether an option strategy is something you'd like to look at or dismiss. Now, the strategies that we're talking about here in the series of videos is really designed, the strategy is designed to provide more income and have this income, because the income is generated from capital gains, this income is taxed very favorably. So the strategy here is to generate more income, if you will, or volatility and time into cash. So let's get started. We covered in the second video selling time and volatility. So we covered what volatility was all about and time and why they were important in the pricing of options. So when you're selling a covered call, which was what the example that, or the strategy that we covered in the second video, you're really converting volatility into time and time into capital gains. And the option premium, when you're selling this option, if you will, it is considered capital gain. We're going to talk in this final video about put sales, what we would call collateralized put strategy. Why the fancy word is essentially it's collateralized because a put is the right but not the obligation to sell a stock. So when you sell a put, you're essentially promising someone that you will buy a stock by a certain date at a certain price. So you have to collateralize it, i.e. put money aside to make sure that if you need to make good on your promise, you have the cash to do it. So again, this put sale generates capital gains. And as we know, capital gains in Canada, only half of them are taxable, and the other half is taxable at your marginal rate. In a corporate account, it's also very attractive because capital gains come and increase your capital dividend, your capital account, if you will, and you can take this capital out tax-free. Obviously, talk to your tax advisor before doing any of this, but it is a very nice advantage to generate capital gains inside of an investment company. Now, the downside of a covered call, the example that we covered in the second video, is that you still own the shares. So the underlying stock, if it sells off, you're still exposed. So in the put sale strategy, you don't actually own the stock outright. You've essentially made a promise to buy it at a lower price and collected a premium for this promise. So effectively, you're like the insurance company. You've promised to pay someone a set price if something else happens. So here we have the profit outcome, if you will, of a put sale. So for $1, the option premium, we promised to buy the stock at $24. So since we collected $1, anything below 23 becomes a loss. So a put is the right but not the obligation to sell a stock. So what we often say is we say, listen, a put sale is like an insurance on a stock. If it breaks, you own it. So clearly, here at Exponent, we don't sell puts on stocks we actually don't want to own. Some people will go out and especially volatile stocks or concept stocks, internet stocks, biotech companies, very often will have a very, very, very high value, if you will, on the call and put options. So you might be allured, if you're greedy, you might want to sell put options on these stocks. The problem is they're so volatile that you might have to make good on your option and actually buy the stock. And if it's not something that you actually want to own, you got yourself a problem. Now, you don't necessarily have to. You can also sell this, buy the stock back, buy the put back So if you sell it and you see it's working against you and you don't want to get exercised. So in our example here, if we saw the stock head to 23 in a hurry and really didn't want to be around to exercise or have our put exercise on us, we could buy it back. We would collect the loss, clearly, but a small loss early sometimes is better than a bigger loss later. But if it's a stock you actually want to own and you've done your research and $24 seems like a fair price to you, it's really 23 because you've collected $1 up front, and you're happy with that price, then you might just let your put be exercised on you and you own the stock. So it really varies. You have to go on a case-by-case basis. But the key here is that you have to be collateralized. That means you have to have the cash in something very, very liquid. Here at Exponent, we use money market mutual funds. Some people might want to do corporate bonds. I've seen that done, and we just don't do it here because why take the risk? If 0809, that crisis, if it's taught us anything, is that liquidity is very valuable. And if you have liquidity when no one else has it, then you're ahead of the game. So if you buy a corporate bond, and lo and behold, there's a geopolitical event or a financial event, and corporate bonds sell off, then you've got a problem because you might not have enough to cover your losses from your put sale, because you might have to actually exercise the put. So collateral is very, very important here. But it is, and the last thing I also want to show you is you notice that the profit diagram is very, very similar to a covered call. It actually is effectively the same thing from a theoretical standpoint. So that's why it's the same shape. Now, the put sale, why would you do put sale versus a covered call if they have the same profit? They generate capital gain income just like a covered call strategy. What they will do that a covered call will not do is you can dial in your exposure. So you can be as close to your exercise price or as far as you choose. So if you're very close to the exercise price, you will actually have a higher likelihood of being exercised, and the put buyer will be willing to pay up for this extra insurance, if you will. And if you're out of the money or far from the strike price, the put buyer may not want to pay up as much. And so you can dial in your exposure that way very elegantly. You might have a large cash balance. You might be waiting for the stock or the overall market to sell off, and you can dial in at what price you're willing to gain exposure at. And so again, you get a little bit more customization, if you will, with a put sale. The downside with put sales, obviously, you can't do them in registered accounts. So RIF, RSPs, TFSAs, you cannot do put sales, only on margin accounts. So why? Well, there's a risk of exercise. So you always need cash to collateralize your exposure. And where most people get themselves in trouble, so earlier on in each video, I always say that to people that options sometimes get abused. This is a great example where someone will not set aside the right amount of money or the right type of asset class to make it very secure, and so they end up being exercised on the puts and don't have any money to pay for it. An interesting put sale, or why puts are always worth more than calls when you're selling them, is that there's a put skew. So put sales are generally more profitable than selling call options. And the reason is really a theoretical one. It's known as put skew. So puts have a higher implied volatility. As we know, volatility has a positive influence on option pricing. And also remember that puts are used as a hedge, and so they're generally in higher demand, whereas calls are usually used as a speculative tool. So generally, option sellers are willing to pay up and have much more of a need for it, and so that's one of the theoretical reasons why. So you've got all else being equal, when you're selling a put, for the same dollar of exposure, you're collecting a little bit more than if you're selling a call. So we can generate more income with option sales. So we covered in the second video, covered calls. In this second video, we covered put sales. We convert this time. This is what we use here at Exponent, put sales and covered calls. You can convert time and volatility into capital gains. Now, we covered also in the second video that there are times when these income strategies work and they're not, and there are other times when they don't. Bottom line, you need volatility for option strategy to work. There are risks. In a covered call, you still own the stock, and in the collateralized put, you can eventually own the stock if the stock sells off. So there's an implied exposure there. And some people find that options can be quite complex. Once you understand the three basics that we explained here in the series of videos, I think it's fairly straightforward. You're essentially making promises, either to buy or sell at a later date, and you're getting income from these promises up front. There are costs. I mean, there's more trading and there's more costs on the management side. Running an option portfolio is not like running a long-only strategy. There's a lot of what-ifs and a lot of modeling that goes into it, and so that most money managers will charge a premium for a strategy like option sales. As we said, trading costs as well. And I would even add at the end of the year, if your tax preparer, if it's yourself or it's someone that is not familiar with option sales, that might add some complexity too. Luckily here at Exponent, we have all the systems, so all of our clients, we track all the costs, and so at the end of the year, the reporting is quite simple. For some, they can view that as a downside. And the other complexity is really when it comes to looking at a statement. Now, when you're looking at your option statement, you'll see a negative. So you'll see in our example here of a GE, which was coming due in June, you might see minus 10 contracts of the GE coming due in June of 15. So some people sort of, the concept of being short is can be quite scary because you're seeing a negative balance there. It's important to remember 1, 2, 3. So the first step of an option sale is that you are short the option, so you promise to sell the stock at a particular price, but you also got paid for it from. So a lot of people kind of forget that they got money in their cash account or in their cash till, if you will, the cash portion of their account for this promise. And over time, all else being equal, this negative balance, the short of the option, goes to zero because on expiration, all options are worth zero unless they're in the money. So if the stock does run on you, you essentially get, you'll see a large negative balance appear on the, or you'll see the negative balance of the option get larger. But don't forget that you already own the stock. So the money that you're losing on the option, you're making on the stock, the underlying stock that you own. So both of them offset each other. But that can be for some that can be confusing. So just remember that when you're selling the option, you receive cash, which is a positive, and then you're short the option. And at least when you initially put the trade on, they're equal. And as time goes by, either the option appreciates or depreciates, I should say, goes to zero. I guess you could say appreciates, or it depreciates. That means it gets worse. So that means your call option is now getting into the money, but since you're long, they offset one another. In a put scenario, the value of the option will decline towards zero, or you basically will own the stock. So if you get exercised, so it's a little different, but again, you're short a put, and so for some that can be confusing. Again, the same type of idea. You sold the put, you've collected money. And if the stock sells off and your put gets more and more likely as it will get exercised, then the value of the put declines further. And so you show a larger loss. And ultimately, either the stock never gets to the strike price and the put option appreciates back to zero, or ultimately you get exercised and own the stock. So thank you very much for watching. We've only touched on 2 of the many option strategies, and probably we touched 2 of the simplest ones. And the goal of these 2 option strategies is to generate income. And in our case, we like to generate income from quality stocks you actually want to own. Our goal for our clients is generate income that is tax efficient, because as clients age, the income requirement increases over time. And the other problem is that under the current scenario of low interest rates, there's not a lot of places you can get income from. So if you'd like to know more about option strategies and how we can help, feel free to contact me at 613-747-2458, extension 40, or shoot me an email at benoit@exponent.com. Thank you very much for watching, and we hope to speak to you soon.